You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you are doing well today. Actually, I hope that you are doing better than Enghouse, the stock that we're going to talk about today, actually. Ticker ENGH. Enghouse, small cap, 1.2, 1.3 billion, now offering a high yield of like 5.20%. Used to be a darling, used to show a very strong dividend triangle, like seriously, like high revenue growth, high earnings per share growth, very generous dividend increases. Actually, that's still happening right now. All that before COVID. And then there was that hype, like the post-COVID hype where everybody was like going crazy. So in 2020, the stock price went up super high and then nothing. And when I say nothing, I'm like, wow, like that was just a big debacle. So the stock price used to trade as like as high as $80 back in the end of 2020 and then dropped and dropped and dropped. And now we're talking about like 20 something dollars. So, and hence the like now going from like a tech stock, low yield, high growth stock to a high yield, small cap companies where management keeps on increasing the dividend, but I'm not too sure why they are doing it because we're still talking about like double digit over the past 5 years, 3 years, and last year increase. So definitely not making much sense when you look at the rest of the dividend triangle. So let's take a look a little bit more about what's Enghouse Systems and what do they do. So basically, a Enghouse system is enabling companies to communicate faster, compute faster with their technology. So that was like the perfect type of service when everyone was starting to work remotely. So using Enghouse system to it's a software company and service. So use their software to communicate and work remotely. So that was like kind of perfect. They work around a subscription-based model. So now they have about 60% of their business revenue that is recurring. But as you can guess, that did not age well. After like the big hype, well, then there's not much revenue growth. There's actually no earnings per share growth. It's actually declining right now. So this is the main problem of the business. In terms of growth vectors, well, they try to make more acquisition. So classic technology company trying to do merge and acquisition, trying to add like software to their service or book of clients so they can do cross sell references. But the problem is right now there's not much organic growth and everything relies on mergers and acquisitions, which, you know, it's like sometimes a good thing, sometimes a bad thing. So acquisitions are a bit tricky. The good news is that the company does not have much long-term debt. So clean balance sheet, has plenty of cash to make small acquisitions. But I mean, growth vectors are weak. It's being reflected in the dividend triangle. The economic moat, I mean, there's nothing. It's a tech stock. So yes, they kind of like, it's a bit of a sticky business if you can see it this way, where like companies, they get used to a software. It requires time, energy, and money to switch over to another software that would do pretty much the same thing. So that is a small mode, but I don't see this as a very solid thing because there's a lot of competition in this field and companies may just see the service as more as a commodity. So, I mean, it works, but I mean, again, you're going to keep your revenue, but it's not going to help you grow. And that is definitely one of the problems. So as you can see, the investment thesis already is pretty weak. And when you analyze a stock, like imagine that you have held like Enghouse for a while, well, the numbers are not good. So the revenue is pretty much stable since 2021. So there's a small dip, was slightly going up, but between 2021 and 2025, we're virtually like no revenue growth. So that's a lot of time, right? And then the earnings per share declined during that period. And while the earnings per share declined, the company kept on increasing its dividend double digit, which doesn't make any sense to me. So already I don't like the dividend triangle. I don't like the dividend growth policy because it's not backed by solid fundamentals. And now you're looking at the risk and you're just thinking, well, small company in the tech world, that could get hurt by any big guys. So that's a problem. Second problem is most, if not all, the growth is really coming from acquisition. So it's similar to what we have seen with open text over the past few years. If they don't acquire new businesses, the organic growth is anemic. It's like there's nothing there. So even though the company has like a very solid balance sheet, they can make more acquisitions, you only focus on that to see any growth. If not, the business itself, it's not really going anywhere. The industry and market threats, well, a lot of the software market is like crowded, highly competitive. There are tons of companies like competing for the same pieces, and a lot of them are a lot bigger than Enghouse. So long story short, I'm sorry to break it to you, but on this one, I don't see how the business can actually make a strong comeback. I don't see it in the numbers right now. I don't like management like still increasing like the dividend. Like in 2025, the dividend increase was like 15%. That's just crazy. I mean, the earnings are not growing. So they are all about, oh, we are growing our recurring revenue. I'm like, yeah, fair enough. That's interesting. And of course, I love recurring revenues. But if they don't grow, you're just increasing your percentage of your business that is coming from recurring revenue. But they need to find some growth vectors, and it's not happening. So for all of those reasons, I would not get into this one. Might as well. It's a high yield at 5%. You might be super excited about that. The valuation, nothing to say against the valuation at this point. I mean, the P/E ratio is at 16. The forward P/E ratio is at 14.6. The average of the past 5 years was 25. So definitely trading at a lower P/E ratio than it was before. But again, you have to ask yourself, why? So sometimes it sounds like a deal, and many times investors have this tendency of like, yeah, well, the stock has been beaten up. The valuation is low. The yield is a lot higher than the average. The P/E ratio is a lot lower than the average. So everything points out to a good buy, especially with a solid balance sheet, right? But here's the thing. There's no investment thesis to back the growth. So yes, you're not paying much for this stock, but are you getting a deal? I mean, sometimes when you don't pay too much for something, it's just not worth that much. And that's the unfortunate reality of many investment. So before I would be tempted to take a look back at Enghouse and consider in my portfolio, and you know how much I love recurring revenue and I love tech stocks, well, this one needs to get the revenue and the earnings per share growth steady back up, which is not happening right now. And for those reasons, I'm definitely out of this one. So I'm sorry if you're a shareholder of Enghouse and I'm bringing this down to you. Again, maybe it's just my perception that is wrong. It's not financial advice, but on my side, I'm not going to go forward with this one. So not a good week for good stocks, right? So main equity was not necessarily on my radar on Monday. Today, we're looking at Enghouse, just looking at more problems than anything else. I actually prefer to rely on the Rockstar list to find my favorite stocks. So the Rockstar list is a list of companies showing a positive dividend triangle. So now you can find companies with driving revenue growth, earnings per share growth, and dividend growth. You can download the list. You can see the link in the show note at moosemarkets.com/rockstar. It's 100% free, updated every month, so you don't have to do anything. We're going to send it to you in your mailbox, which is kind of cool. And yeah, so all right, Moose, I am coming back from vacation tonight from Peru, so that's gonna be crazy. The regular show will come back next Monday, but we're gonna have like a Retirement Friday show this Friday as well, and then we're gonna come back to the 5 podcast per week schedule starting next week. So until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.